We spoke last week on Monday about this picture. Okay. That's where I kind of left you. This picture tells me a number of things. That is, I want to invest a certain amount of money, not in just one asset, but I want to diversify or distribute my investment across a number of assets. Okay, that's the first thing. The second is, of each of those assets, I can think of an expected return. That is, if I buy that and hold it, then after a period of time, I expect to become a little bit richer. The second concept relating to that is that there is uncertainty in the future, and the price of this may go up and down. And we are going to look at the variance of housing change as a measure of risk. Things go up and down, and if it varies a lot, I'm going to interpret this as a risk that I'm facing. So there is expectation risk factors, aspects of investment in any asset. The third point relating to that is that if you try to invest in a number of assets, some of them may be correlated. And this is expectable because different companies might depend on some underlying thing, like oil prices, say, and if that goes up or down, then those that are dependent on that may go up and down jointly, so they will be correlated. Okay? So once we have that, and we restrict our thinking to just first and second order statistics, that is expectation and variance, not higher order. So if we restrict ourselves to expectations and variance, then we can think of the returns I get every day on the portfolio that I have invested is something I would model as a multivariate Gaussian. Okay, because a Gaussian distribution is characterized by mean and spread only. No higher order terms, no higher order parameters. It's fully specified by mean and covariance. If I restrict my thinking to mean and variance only, then I can model the distribution of my returns as a multivariate Gaussian. Okay? The portfolio that I have, which is my money invested in certain proportions across these basket of assets, will give me a return in proportion to the returns on each one of them. So that's a linear transform, a scalar product between my portfolio proportions and the returns on each of those assets. Okay? Immediately, a property of multivariate Gaussian distributions becomes applicable, and that is a linear transform of a random vector, which is multivariate Gaussian, is also a multivariate Gaussian, whose mean vector and covariance matrix we can immediately write down. That's a very standard result. Lots of things in life kind of go from there. Okay? So what we then would have is that once I design a portfolio with a particular weight profile, particular investment profile, I can write down what's the expected return of this, which is the weighted average of the expected returns on the individual ones, and what's the expected variance of this, what's the risk of this. Okay? Once I have this, I can ask the question, I have a space of expected returns and variances on them. Okay? So this is the space that I will have. Any portfolio that I construct will have an expected return on that portfolio and a risk associated with it. There will be one point in this space. Okay? If I just randomly change my portfolio, I will be in some part of this space. It turns out that there will be an efficient frontier, and points in this part are not realizable, however you change the weights. That's something we can intuitively understand by saying, if you are on this point, you are demanding that at a particular risk you can tolerate, I want to be so greedy that I want that return. Intuition says that may not be possible, because the individual assets, their correlations are all fixed, given to me. Okay? Alternatively, you can think of this point as saying, I want to achieve this particular return out of my portfolio at a very, very small risk. I seem to think I can do this, but it is not possible. Okay? So this boundary tells me that those are realizable points. Sorry, these are realizable points, these are not. And any point on this can be achieved by solving a quadratic programming problem that says minimize the portfolio's risk, subject to achieving that return. So that's what we came to in the last class. And to know this one, these two corner points are also very interesting. So this corner point is what's the largest return I can achieve given all the mean portfolios without any reference to risk. Yeah, so that's how, as point 2 is as high I can go for this particular sets of means, and I will not be worried about risk. That'll give me that corner. This one would be what's the minimum risk I can achieve without any reference to my group. Yeah? I don't want to specify I want so much money. Out of this mean vector covariance matrix parameters of these stocks, what's the minimum risk that sits there? Yeah? So these 2 points are at this corner and that corner. And then just by demanding different points along that y-axis, I can solve a quadratic programming problem and draw this curve. And I gave you a piece of code that does this. Yeah, copied off the book. I didn't write this myself. And what this function does is to give it a return vector. So ERIT is a vector of returns, which is the mu in the notation that I use. That's the covariance matrix. That's the C in my notation, or sigma in my notation. Yeah. And this tells me the number of points I want on that frontier. Yeah. So if you look here, so I have a covariance matrix. I have a mean vector that you can't see in the picture. This curve is traced at a particular resolution. So how many points on this do I want? At what resolution do I want to trace? So that's what goes into that function. You should be clear what goes in, and obviously you should also be clear what comes out. It tells me at particular, at this many points, I will have the risk of that portfolio, I will have the returns on that portfolio, and what weights satisfy that risk expectation balance. Okay? So is everyone clear what goes in and what comes out? Yeah? There was a question about that. Did anyone punch this in and chuck this matrix and vector in and get this graph? Yeah? Worked? Didn't work? Did work? Been tried? Yeah. It happens with just cut and paste. Next year will be horrible. I'll give an image of this so that you will have to be forced to type. Okay, so that's where it is. So that's Markowitz's invariance portfolio. I mean, it's quite, when you think about it, you can think 2 things about this. One is it's quite cool. The other is, yeah, it's so simple, right? When you stick to first order statistics, it just pops out. Okay. What we will do is, so this is 1952 stuff, so that's quite old, and you're paying a huge amount of money to study in 2015, and it's not quite nice to stop here. So we'll look to see how people have tried to build on this, and pick a very recent piece of work that builds on this, and try to learn a few more computational modeling techniques built around this. Okay, so that's our goal. You also have to remember how the whole thing works, and there is a fundamental compromise that comes with it. We have these 2 parameters, the mean vector of expectations of these individual stocks and the covariance matrix of the returns on those stocks. It doesn't come magically. Data doesn't come out of such a distribution. You have to estimate those. Yeah? You have to estimate those from data. And our hope is that if we have a small analysis window, you took all the data here and estimated the means and covariance matrices on the returns. Hopefully, at this, you sit at this time, you look back, collect some data, estimate means and covariance, run the optimizer to design a portfolio of your choice here, invest your money according to that portfolio, and then sit tight watching what happens. Yeah? And after some time, you might be lucky, you might have made a lot of money, you walk away. Or periodically, you might think you might rebalance the portfolio, because once you are hit here, you have a lot more data. You might think that the mean and covariance might have changed, so you might re-estimate this. Okay, so that's quite obvious, right? So this is what one would do. Yeah. So periodically, you might rebalance the portfolio based on new estimates of mean and covariance if you are running a position like this. there is a fundamental trade-off here. So you will know if you want to estimate something from data, the more the merrier. Greater the data, the better the precision with which you can estimate this. Yeah? Or less is the uncertainty with which you can estimate this. Okay? Estimate a parameter. So you would like to think when you're sitting here, you want to estimate mean and covariance from a lot of data. You want to go right back over here and look at the performance of the whole thing and then estimate mean and covariance. You have the formula how to do this. Yeah? But the compromise here is that it may well be that over time, what you're trying to estimate might have changed. Yeah? So there is a compromise between the accuracy with which you can estimate and the stationarity with which these signals are behaving. Yeah? And that's an inherent trade-off that happens in any time series related work. If the underlying signal is stationary, then what you estimate, the functional relationships you estimate, stay constant, and you don't have to do anything. But it is possible they would change, and it is in reality they will change. So you will have a compromise or trade-off between how long a window can you estimate this from, and the precision or accuracy with which you can estimate something. Okay, that's that. There are various tricks, and this is particularly true with covariance estimates. So remember, if you have 100 stocks that you are trying to model, you want to invest in 100 stocks, then the covariance matrix you're estimating is 100 squared. Yeah, and it has 100 squared by 2 free parameters. Yeah, so 100 squared by 2 free parameters. It's symmetric. You will know this is symmetric. Okay, so that's a lot of free parameters. As a rule of thumb, you would think that if I want to estimate 10 parameters, I need about 100 data, 10 times that. Yeah, if you didn't have that many, a little bit more data than the number of parameters you're estimating, you would find the estimates unreliable. Yeah, so there are a lot of tricks to say if the estimated covariance matrix is not good, it causes instability in things and optimizers. We'll see that a bit later. Shrinkage is a term used very commonly in this kind of situation. Yeah? Statisticians come with the term shrinkage. If you have done the machine learning course, you would have seen the term regularization. Yeah? That means exactly the same. So people would estimate a covariance matrix from data just by throwing the formula at it, and then do some tweaks to this, and that tweak has many interpretations in many communities. Okay, and we'll see a little bit of that as we go. Okay, so what we will do in the coming week and today is to look a little bit closely at a particular paper, Sparse and Stable Markov-Risk Portfolios. It appeared in 2009, I believe, or 2000. There are a couple of different versions of this. The initial paper appeared, I think, 2 years before this, and it was properly published in PNAS in 2009. So we'll look at it a little bit closely at these guys' work and see how they construct sparse portfolios and what is their claim about stability of the portfolios they construct. Okay? And there will be a couple of other reading things that come along with it, but this is what I will focus on. Bruni's paper is what I'll focus on, and that will also become the coursework that you will do. Yeah, so you will try and see if the claims that Brody makes in that paper are actually valid by taking some data from the exchange, trying to implement what he has done, and trying to confirm whether his claims are true. Okay. Okay, so there are a couple of other things that are worth quickly mentioning. We are always interested in mean as if there is a distribution of returns, we are interested in the mean of this return as something that we are getting out of it, and how is it spread? The risk is coming from standard deviation. Yeah. The Sharpe ratio is a ratio that's used very commonly as the mean to standard deviation ratio. But often you take off the risk-free interest rate. So you thought, I have invested in this and gained so much on average. But of course, instead, if I had put my money in a fixed deposit in an almost risk-free investment, then I would have gained something anyway. Yeah. So what is my excess over and above that, normalized by the variance, is a term used often to quantify how well this portfolio is working. That's what it is. And a related one is known as value at risk. What this says is, can I think of, okay, so here G is a loss you're going to make. So you have invested some money and you have lost some of it. Yeah. once you invest in this portfolio, there is an expectation that I will get so much back, and there's a risk associated with it, there's a variance, so it's probabilistic. Okay? So the question is, how much would I lose? What's the kind of worst case loss at a particular level of confidence? Yeah? So I can define a value B with respect to my investment, where I say that the loss, okay, if G is loss minus G is now positive, the loss being greater than this number is of that probability. The probability that I make a loss greater than a certain number is that one. Yeah. So if I think I've invested money and I have a distribution of the returns on this, currently I have a certain amount of money, so there will be a loss distribution associated with my investment, which is just a shifted version of the of my expected return distribution. Yeah. In that one, there is a tail. There's a tail value, and this value, the chances of exceeding this value would be some 1%. So if someone says that this portfolio stock has a one-day 5% value at risk of 1 million, what they mean by that is there is a 0.05 chance, or probability 0.05, that the loss you make is 1 million. Okay, so that's the way to define this. We'll calculate this as well as we go along. There's a MATLAB function that calculates it. Okay, you can easily believe what this wants is a return on this, a variance on this, and some threshold that you might tolerate, just like the 0.01, and the current value of the investment that you have made. Okay, so it's the current value. It's from the current value that you will make a loss. So what's the loss distribution, and what's the area under the tail of that loss distribution? With me? Okay. There's a related one. We will come back to this later, called conditional value at risk. There are some specific properties of this that do not enable, would not let me integrate that into optimization algorithms, and this is a lot more popular, but we'll come back to this later. Okay, so that's neat idea, looks neat, it's doable, we can all do this. So this guy's paper, I have referred to this earlier, you can find this. These guys did a very large scale empirical study on different markets of many different investment strategies that are variants of the Markowitz portfolio that we have just learned. Okay, so they would compare. Okay, so the simplest strategy is 1 over n. You have n assets. You invest your money in 1 over n on each of them, equal investment. Okay? That's the naive way of doing it, and then you would rebalance as we go along. That's the classic way you would estimate mean and covariance matrix. You have a sample, you average to get the mean, you take the vector, subtract the mean, times its transpose, average it, so estimate the covariance matrix. It's based on samples. And there are variants of this. So Bayesian methods are methods that make parameter estimations with some prior knowledge. So if you think that I have a prior on these parameters, what is the current estimate based on data coming in? We might look at that a little bit later. There are people who impose additional constraints in devising an investment strategy. You might say that, okay, the Markowitz portfolio optimization gives me this as the particular weights, but if the weights are below a certain threshold, I might not invest. If the weights that the algorithm is giving me are very, very high, I may not go that far. I might put some bounds on it. And there are many strategies published by people on constraints. Combining models and averaging different models is again a very, very popular trick in many areas where you want to make a model out of data and then do this and do something with it. Yeah. You would do multiple models and take averages of models. It may well be, if multiple models have uncorrelated errors, then averaging the predictions of multiple models would cancel out. Okay? So that kind of trick exists. So these guys went and looked at a very large empirical study of various things, and they came to this conclusion that everything I've been telling you is kind of not particularly correct. No, not correct, but it won't make money. They say that there is none of these methods would consistently beat the naive strategy of 1 over n. Yeah, just put all your money in So that's quite cool to do. Okay, so what did Brody say out of this? So what more can we build from this very basic setting? We'll have some, so I have, there are some things I have done that I have not told you about. These slides exist in the front page of the course website, okay? So if you go to the ECS course website for this course, there is the front page and there is copies of these slides. And I have a sentence there that says, this is a dynamic set of slides, because I'm making them as I'm teaching you. So this slide set will grow, right? So these were made last night. Any errors in them will be corrected tonight, but you will have just one file there, okay? So you don't have to very hurriedly write it down. With me? Okay. So okay, notation. So what do these guys do? So they start by, okay, so let's define R of t is a vector. And this vector has R1, R2, up to Rn components at time t. So this is a vector of returns at time t. As t changes, this is going to change. Okay? The average of those, the expected value of those, is our mu. We know this. The expected value of a vector, take away the mean times its transpose, is the covariance matrix. We're going to call it C now. Okay with me? That's just the basic definition of expectation. What we did in constructing a Markowitz portfolio is to say what's the minimum risk, yeah, for a choice of W. So that is with respect to W, I want to minimize this quadratic function. Yeah, that's my risk. And I do that subject to my expectation, so this is my greed level, and the proportions with which I invest should be 1. So this vector 1, so this is nice little algebra. When I write 1 and subscript n, it's a vector of 1s, 1, 1, 1, 1, 1. Okay? So if I say I want to add up all the weights to be 1, in algebraic form, I write this as vector 1 transpose times W should be 1. Okay, with me? It's just convenience for me. And if I formulate the problem this way, I'm not constraining the weights to be positive, so I'm allowing short selling. Yeah, that is, I'm allowed to have in my basket things that I have sold someone which I don't have. Yeah, that's what short selling means. Okay, so, and then we know this is not quite correct. This parenthesis should come here. The way you define covariance matrix is expected value of something squared, take away the mean, or the mean squared. Yeah. So variance is computed as averaging your random variable, take away the mean squared. Yeah? Which is the same as averaging the random variables squared and take away the mean squared. Correct? You've got to be able to think this. Okay? I won't write it, you will write it. So we plug this algebra in, and you can write the same optimization problem in this form. So what do I have here? I have a matrix called R. So R is going to be a matrix in which I stack all the returns. I'm going to have a matrix R, which is going to be T times N. So that's amount of time times the number of stocks. Yeah, so every stock here has a return as a function of time. Yeah? So now what you see in this one, there is a couple of steps of algebra before you can get to this from here, from this specification. But I'm going to leave you to do this. That will force you to read the paper. So what we will have is that I'm going to estimate a weight vector. The weight vector is the proportions I'm going to invest in. Is minimized with respect to W. The average of this would be a vector of ones. So what I expect, rho is my target return. So there will be rho here. I'll have that is that vector. I want to take away from that So R is going to be like that. That's not correct. This is a bit. So I want to have that one, row up to row. Take away R times W. So this would be T of them, every point in time. R is going to be T by N. So let's draw it this way, T by N. So the number of stocks is smaller than the time window, the way I have drawn this, times W. So W is the number of stocks. It's going to be like that. Yeah? So that's what I have here. So, oops. So the optimization problem I had here, which says minimize this covariance matrix times weight subject to this constraint and this constraint, can be, with a little bit of algebra, 2 steps of algebra that you're going to do as homework, can be written in that form. The constraints remain the same. W transpose estimate of mu should be rho. That's what I'm going to expect as a return. And my weights should sum to 1. Okay? And what I have in that step is okay. I think if I'm here, I'll be safe. Okay. So over here, I have all these rows sitting there. Take away the matrix of return. So R is data. We have this. Yeah? Of every stock, what are the daily returns? I have this R matrix. I throw R in here, W in here, minimize this expression, subject to the same constraint. Okay? So you can very easily, so this avoids the step of explicitly computing the covariance matrix. Yeah? And there's a reason for writing it this way, which will pop out in a second. Okay? And what will pop out? Okay, so now if I put this like this and try to solve it, it'll turn out that the columns of R can have very strong correlations. Yeah, so if there are 2 stocks behaving very, very similarly, heavily dependent on the same underlying factor, then the columns of this R can be correlated, very strongly correlated. Yeah? So when you have strongly correlated columns, you will have numerical stabilities in solving this problem. Why is that? You have a matrix, and if the columns, some of the columns are very strongly correlated, they can be expressed as a linear combination of other things that you have, other columns you have. Yeah? If you can express some column as linear combinations of others, the rank of the matrix, is this term known to you? Yeah? The rank of that matrix is smaller than the size of the matrix. Okay? The rank of a matrix is how many linearly independent columns you have. Okay? So if some of the columns are expressible as a linear combinations of the others, then it's an ill-conditioned matrix. When you start doing optimizations with it, we will run into numerical stabilities. Okay? What does it intuitively mean? So suppose you think of 3-dimensional space. So this is in n-dimensional space. Think about 3 dimensions. I can have a number of points in 3 dimensions and write it in a matrix and say, oh, this is 3-dimensional data. Okay? If I say one of them is linearly expressible as a combination of the other 2, then my 3-dimensional data lives in a plane in that 3 dimension. Correct? So that data matrix that I get out of it is actually 2-dimensional data, but I have got 3 measurements. Okay? It lives on a subspace. And that kind of scenario is kind of bad. Yeah? It leads to ill conditioning. And the paper, when you read, you will find it uses things like condition number, but we won't bother about it. Okay? But the intuition is this. Okay, so what you do if there is a problem like this, you regularize it. Yeah? So we have, remember, some of you might remember this, we said some time ago, this is a little aside for those of you who did the machine learning course, if you did linear regression, you have a data matrix, yeah, so call it Y, and you want to find the vector A such that you minimize the difference between this one and some target. So that's the linear regression problem. Yeah, and those who did the machine learning class will remember this. Others, don't worry, it's not. Well, it's similar. That the solution to this is Y transpose Y inverse, Y transpose A. That's a pseudo inverse. Yeah. The point I'm making there is exactly the same as saying if you construct this matrix and try to invert it, it will not have an inverse you can easily calculate. Yeah? So if the columns of Y are dependent on each other, if one or more of these columns can be expressed as a linear combination of these, then this will be a singular matrix. Yeah? It will not immediately have an inverse. So what's the trick we do to do this? To solve this, we take Y transpose Y plus some alpha times some diagonal matrix, and then take the inverse. Yeah? So that's a numerical analysis little trick to avoid numerical stability of this. Okay? And what have I done here? I have added a little number to all the diagonal elements, a tiny little number. Yeah? So that will force this to be conditioned and enable me to invert this. Okay? So that's numerical analysis idea of a hack to regularize something that's causing numerical problem. But of course, we know this is exactly the same result, yeah, as regularizing to achieve out-of-sample performance, better out-of-sample performance. And I will do that by saying don't minimize this one, but minimize this one plus some alpha times a penalty. Yeah? If I set up my problem to say, find me an A to minimize this error plus a penalty, so that is now going to be the error that I'm going to minimize. An error on data and a penalty that I'm artificially foreseeing. Yeah? And this has other Bayesian interpretations that we'll talk about, possibly talk about later. Okay, so that's what drives Brody's life. And Brody wrote this in this form and then says, okay, let's do, instead of a quadratic regularizer, an L1 regularizer. This is also something you have seen. Yeah. So what would I minimize? Minimize this one, which we have already seen, plus some small number tau, times the L1 norm. The L1 norm is the sum of absolute values of each of the components. Okay. So if this vector W has terms W1, W2, W3, so then there's a sum of absolute value of W1 plus absolute value of W2 plus absolute value of W3. Okay? So what have we done? We said we want to minimize this to construct our portfolio. Now we are saying, well, that's not what we're going to do. We're going to have a little penalty term sitting next to it. We're going to minimize this one. Yeah? So again, a compromise very simple. If tau is chosen to be very, very small, then you're not doing anything. You're not adding a regularizer. It's the same as this one, minimizing this one. Yeah? If you set tau very large, very, very large with respect to the numbers here, then this will have no effect. Yeah? So the minimum of this, the solution would be all the W's would be 0. Correct? That's the best you can have. You want to minimize this. You have a big number here, weighting this term, and this is with respect to the errors here, if that is very, very big, then the minimum of the whole thing is 0. Correct? With me? Because if we just ignore this one, then what's the minimum of it? It'll be 0. Yeah? It turns out, if you find sensible values of tau, somewhere halfway between, you will find solutions that will fit the data reasonably well and make a number of the components of W 0. Several of them will be 0. So the solution that I derive out of this, as some of you have seen before, is a sparse solution. Okay? There's a technical reason why this happens. I can go into that at some point, but maybe not now. Okay? But if you think about the two extremes, it's this is set very high, the best is all of them are 0. Somewhere in between, some of them are 0. Let's stop there for a moment. Yeah? Okay. So that's what they suggest. And then they go and, okay, so they say if you did this and regularize this, then the resulting solution would be a stable solution with, sparse and stable portfolios is the title of the paper. Yeah? So you have induced some numerical stability in solving this. There's something else that you can do with this. Once you have this framework, you can say here are a number of returns on several different assets. A weighted sum of them is going to achieve for me my greed, the return that I want. Yeah. An alternate place where you can apply this is a problem called index tracking. So think about being a passive investor, just like what we were. Buy a bunch of stocks and sit there. Yeah. Don't actively engage in trading. What you might want to have as a return on your investment is you may want to have your money grow just the same way the stock market grows. So you might think that if I put all my money in a bank, in a long-range interest-only investment, I might get some risk-free interest rate of about 1%, 2%, whatever it is now. Yeah. If I put all my money in, but I observe the stock market over a long period of time, and that seems to have grown much faster than what basic interest would give me. It's a bit risky, but it seems to have grown faster. But I don't want to pick and choose different stocks. Yeah? I might just want to put all my money so that in a way it grows the same way the whole of the stock market has it grow. Yeah? So the way to think about doing that is to say I want to buy the FTSE 100 index, yeah? Which is an index of a basket of 100 companies weighted in terms of how much market capitalization they have. Okay? So if I invest in all 100 companies in proportion to how much they occupy the market, yeah, then my money will grow just the same way as the FTSE 100 is going to grow. Yeah, so it makes sense. There isn't an object called FTSE 100 to buy. I would have to buy shares of 100 different stocks in the right proportion so that my money will grow just the same way FTSE 100 grows. What will go wrong? What will go wrong is that I will incur 100 transaction costs. Yeah? And as I want to rebalance my portfolio as different companies pop out and in FTSE, or their market capitalization changes, I may want to rebalance my portfolio, and I have to do this on 100 different stocks. Yeah? So my transaction costs I would incur would be very, very high. So what we can ask is, can I think of a small subset of those 100 stocks? Yeah? Dominant ones. Yeah? So that, say 10 of them, that will approximate the performance of that index. So if I ask that question, I can formulate immediately a regression problem, and actually a sparse regression problem, which fits into the formula that I wrote before. Before that, if I say, okay, so I have observed the returns on 100 stocks, and I have also observed the returns on FTSE, and I want to ask, what's the best 10 that would perform as similar to FTSE in some weighting that I compute? So that's a combinatorial problem. So if I say, and it's known as an optimization problem with a cardinality constraint. So this is how I would write this. I would say I want to minimize the difference between what FTSE does, FTSE 100 does, and the individual stocks times weights. Yeah, so what weights should I choose that if I weight these individuals in that proportion, I would minimize the difference between what this gives me and FTSE, but the cardinality of that set is some bounded. Yeah? So in that example, this is 10. So remember I wrote L2 norm, which is the sum of squared of everything square root. I wrote L1 norm, which is the sum of absolute values of everything. Yeah? This zeroth norm is how many non-zeros are there in that weight vector. Okay, so that's it. That's the meaning of this. So I can say the cardinality of this set should be some bounded. How can I minimize this? And this one is a combinatorial problem, because you will have to search for 10 out of 100, and you can immediately write down this is a massive number. You cannot exhaustively compute all the possible subsets of 10 and choose the best 10. Okay? it turns out, okay, so that's zeroth norm is number blah, 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 blah. That's of combinatorial complexity, and okay, right. So what one could do, if you can't search for all 10 out of the 100, you can have a suboptimal algorithm. There's a greedy algorithm. So a greedy algorithm would say, what's the best one that correlates most with the FTSE? Take that, hold on to that. Of the remaining 99, which one should I choose so that I have a best 2 subset solution that best matches the FTSE? And then I hold on to the second guy as well. Out of the remaining 98, I search through which one would I include so that I have the best 3. Yeah, you can very easily write down such a greedy algorithm and implement it. And that will not give you the best 10, but that's close enough. Okay? A relaxed version of this problem. Relaxation is a technical term here, but we'll use it a couple of times so that you understand it. A proxy to achieving the same thing is actually this L1 regularized regression we have just written. Okay? So I can have FTSE here, indices of the returns on every stock here. I want to minimize the difference between this and that, plus this tau times W, and as we said, this will become a sparse solution that comes out. Okay. And this paper, Brody's paper that you are going to read, makes many claims to say from that setting, there are many things you can do. Little variants you can achieve. One of them they claim is you can include transaction costs. So you can now say, so here's an optimization problem. If someone told you that on every asset, if you want to buy it, you will incur this transaction cost, yeah, then you can include that into this. So you can say minimize this difference plus tau times the absolute value of the weight that you're trying to penalize, but weighted by the transaction costs associated with that asset. Yeah. Transaction costs come in 2 ways. Normally, you will have a fixed transaction cost. You want to buy something, you have to pay a certain amount. And there will be a transaction-dependent part of transaction cost. Depending on how much you buy, there would be an amount to pay. Yeah, it's associated with the liquidity of the market. How easily can you buy or how easily can you sell? Yeah, there are some things you have to pay a lot to sell. There are some things you can easily sell. And there are a couple of points. You know, if you're an institutional investor, it's this fixed part is kind of negligible. All these banks have trades deals across them. If you're a small guy, then it's a fixed cost. You just go out there and buy a share in something. It will almost be just a fixed charge for you, not based on the millions of shares that you're going to move around in certain manner. So they're small. So there are some aspects like this, and people would optimize this kind of thing with functions thrown into those transaction costs. Okay, that will be slightly more involved. We won't do that hands-on, but I'll give you some reading material. Okay, so Brody also claims that one of the things you would do is not actually start buying a portfolio from scratch. You will actually be solving a problem of currently having a portfolio. Then you realize that the covariance matrix means have changed. You want to rebalance this portfolio. You want to adjust this. Okay. So you can write out an optimization problem like this, they claim, and fair enough, it's exactly the same. So we have W is the portfolio that I held, and I want to ask, can I make an adjustment to this? Yeah. And the adjustment I make would be minimized with respect to my adjustment. This new portfolio, the error between my expectation and the new weight and the return computed from the new weights, yeah, and the penalizing term will apply to the change that I'm going to make. Plus the same similar subject constants. Okay. So now comes homework. Yeah. So we will try and confirm some of the claims in Brody's paper for the first coursework. So I will write it in a way that I will structure it so that you do a few things. And once you have done a few things, then you will read Brody's paper, and there will be a few claims that you can confirm or deny or whatever. Yeah. So I think it's time to download and start reading the paper. I think I've given you enough to go through the algebra. And if we get stuck, then we can have a look at it again. We will use this toolbox called CVX a lot to do this optimization. And this is in your, some of you know this already. You can download this, you can set it up, you can start working with it. It's very, very easy. Brody Roy's paper, when you start reading it, goes into some details about how they implemented it, the actual, a little bit detail of implementing optimizing. Okay. We will bypass that. We will bypass that because there is a very